with 2024 in the rearview mirror, let's take a look at the market wrap up for last year. Just some key points to think about and some things to think about and look forward to in 2025. This week on Phil's Tax Hacks and Other Retirement Facts. Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist Phil Putney. Now let's get rolling with today's show. Hey everybody, welcome into the podcast. Thanks for hanging out with Phil and I, and welcome to the new year. Phil, my friend, we are into it yet again for another season of Phil's Tax Hacks and Other Retirement Facts. How you doing?
Doing great.
Yeah, good. Good to see you, man.
You're good. So you too.
Yeah, man. Looking forward to having a conversation. We got a lot to do. So I want to kind of do like a wrap up of 2024, some highs, some lows, some things of that nature, and then kind of look at some stuff happening for 2025 that could be on the radar. Obviously, stuff's going to be coming at us fast and furious this first quarter of the year. We got the inauguration coming up soon. We got, change in administration.
A lot of changes happening.
Yeah, so we might be a little bit busy here on the podcast for a couple of weeks. So let's just get into it, start rocking and rolling a little bit, and talk a little bit about the wrap up of 2024. Quite the roller coaster, right? Two strong years in a row.
Yeah, it was. Yeah, two years, 20 plus performance on the S&P. Haven't seen that since the 90s. So yeah, I mean, a good couple of years, a little bit of a roller coaster last year. I mean, it started out really strong and then run into some volatility, and then the last quarter, kind of back and forth. I mean, we all lived through it. We know what happened,
the political stuff, the Fed rates, the Fed cut.
Everything was going good, with the election. Markets really liked the outcome there. And then the Fed, of course, starts talking and puts a little doom and gloom on what they think the rate cuts might be for 2025, and the market did not like that.
Way to go, Fed.
That's right. That's right. So whenever they open their mouth, it always changes everything. But
exactly, right. So when we're talking about the various things that happen, like you said, 20%. I mean, that's pretty great. People have were super excited about a lot of that. But I think, you got to take that with a grain of salt too, right?
Yeah, absolutely. Yeah, and we've talked about this a lot of times. I mean, the vast majority of that came from the mega companies, right? And if you look at the S&P, the Magnificent Seven, so to speak, kind of led the charge in technology. So those were the leading indices during that time frame. With basically AI, AI kind of came on the scenes late 23. But 2024 was really the year of AI. So that's going to be one of the things looking into next year is, does that continue? Markets are always kind of preemptive in all their moves. So they're really anticipating this AI growth and this is going to continue. A lot of money has been spent by companies this year. That's why, the chip manufacturers have done so well as everyone's trying to implement AI and build it into their infrastructure. We'll see where it goes. The concern is, does that over the next year, 2 years start to lead to better performance and, improved economies of scales and cost savings to these companies for all the capital outlay that they're having to generate. So.
Well, and we saw such weird things too in the last quarter wrapping it up, right? You had the government coming out saying, hey, we kind of, didn't release our jobs data correctly. They changed a bunch of stuff there. That got a little weird. Then you had the election. You had what they called the red sweep, right? So since all that happened, the market seemed to be very happy about that. We saw some good growth there. I mean, what the S&P got to 6,000, right?
Yeah,
hit a new number. So. And then, December
quickly broke down.
Yeah. Well, and December started off all right, and then to your point, the Fed opened their mouth and then it got a little wonky, but it did kind of end on a positive note. So, I mean, that's good as well.
Oh, yeah. Yeah. I mean, overall, it ended on a positive note, but I mean, it still hasn't recovered back to that. So, I mean, it's right. Well, we'll see what it does. I mean, it's kind of set this line in the sand, so to speak. The S&P did. Mm-hmm. So it's going to be over the next couple of weeks. We'll see what happens if it retests that bottom,
right?
And starts to lean in that downward fashion. We might be in for a volatile first half,
and that would make sense. I mean, considering administration changes, as volatile as the stuff has been with political landscape, a lot of the things that Trump and his administration are wanting to do. I mean, you and I talked about this. When the election first happened, it's gonna take some bumps and bruises to fix some of the financial woes that the country has. So
right, yeah, it's going to take some time. I mean, and again, the markets have built in the hope that with the red wave, so to speak, coming in, there's going to be improve taxes. They're going to extend the Tax Cuts and Jobs Act.
That's the thought.
That's the thought. That's the plan. There's going to be, increased deregulation. So stimulus to the businesses, so the hope is there that this is going to start to stimulate and grow the economy. So that's the challenge there is that's what they've built in.
Yeah.
So if they run into any kind of a hiccup or even a slowdown with that, that's where you might start to see this volatility. I mean, that's what happened with the Fed in the fourth quarter. Because
exactly.
They had already talked about 2025. There was going to be 4 to 6 rate cuts. And then when they announced, well, it's looking like maybe 2.
Yeah. Yeah.
That's not what they priced in, so they didn't like that.
Right. Well, let's do it real quickly, just a couple of sectors, top performers, and then we'll turn our attention to 2025.
Sure.
Obviously, like you mentioned, tech obviously led the way. It's been leading the way for a number of years, right? Small cap was kind of weak. Small cap didn't do so great.
Yeah, small cap and real estate, those two struggled, which is typical. I mean, kind of interesting as the Feds were cutting rates, actually the 10-year treasuries, the yield started to go up.
Yeah.
Which is kind of
the yield curve, right?
You're thinking, wait a minute, the Feds are lowering rate. How did the rates go up? And the treasuries, and a lot of factors that play into that. But one of them is the demand. I mean, if you think of everything going on at the same time, we've got the Fed also doing their quantitative tightening. So they're no longer buying all these new bonds. So now they're having to raise interest rates to kind of entice people to invest. And because those industries, small cap and real estate, are both very interest rate sensitive, I mean, they both heavily rely on debt, that didn't fare well for them. So again, we'll kind of see. I mean, if this levels off and rate cuts continue to happen in 25 and the yield starts to drop, that could be very favorable to small cap and real estate both.
Okay.
So.
It was interesting too, because, the cooling, I know real estate markets are different pockets everywhere across the country. In my area, very minor cooling. I've seen some house prices come down a little bit, but certainly not a lot yet. So it's still pretty strong in that regard.
Yeah, same thing here. I mean, the house price is pretty resilient, which has surprised me throughout 25 with the interest rates, where they're at. So,
I mean, it makes it a little more enticing, I guess, if the mortgage rate would be a little lower right this minute. And of course, if they cut more, that'll get even better. But I'm still surprised the housing market hasn't taken a bit of a tumble yet. And maybe that's good, So maybe, it's not good for people wanting to buy a house because they're priced out of control. But maybe not too many dominoes falling at one time is not a bad thing.
Right. Yep.
Yeah. All right. Well, so what to watch? Let's get into 25 then, right? So, obviously the reserve, obviously the Fed is going to be the big piece as to what to watch. So thoughts there? Yeah,
we got to keep an eye on the Fed. I mean, they already said they're probably going to do 2. But the reality there, it depends on what happens with the economy and inflation.
Mm-hmm.
One of the reasons I think they pulled back on the 2025 rate cuts is we started to see inflation not slow down, but actually kind of level off and gain a little bit again, come back.
Mm-hmm.
So that's going to be a concern going into 2025 if inflation does level off and starts to.
Wait, you mean the 2.5% they claim that it got to is not not accurate?
It's not there. So just like the jobs number. So I mean, we'll see. That has been, this economy is still consumers are still spending. So causing that inflation to hold kind of tight where it's at, which, I mean, fourth quarter, that's pretty typical. You get the, Santa Claus rally, everyone's spending for Christmas.
Yeah.
So the first quarter is really going to be a good indicator on where we go from here. Does that continue? Hopefully we see inflation level off and start to decrease again. If that happens, the Feds will continue on rate cuts. Right now the market's priced in 2, so that's good. The real risk is that if inflation doesn't cool, and the economy still stays strong and starts to grow again, then they might end up maybe pausing. Worst case, if things get really bad from an inflationary standpoint, maybe start to raise interest rates. I mean, if that happens, then now we're whole nother ball game.
Yeah, exactly. Right back where we were at a couple of years ago.
Now we're back to exactly 2022 all over again.
Yeah, 2022. Yeah. Well, so the analysts and the economic outlook for companies, right? So obviously this is where a lot of the Trump policies are going to come into play, right? Is doing things to help spur on growth, economically within the country, jobs and company growth and so on and so forth. So they're looking at S&P earnings between 8 to 10% growth is what they're kind of calling for, right, in the new year. That would be good.
Which,
that would be
that's
favorable.
still pretty good. Coming off 20 plus years in a row, I mean, you can't expect a third one. That'd be crazy.
Right.
That'd be actually, to me, that'd be very concerning.
It's more worrisome, right? It's funny, right? Because a lot of times, the people sitting back here, like us, lay folks who don't do this every day, we're going, hey, yeah, give me 20% every year. I just was having a conversation with somebody, Phil, and he was like, my portfolio's done really well the last couple of years, and I'm like, yeah. And we were talking about what I do for a living, and he's like, if I can just keep, that 15% a year every year, I'll be fine in retirement. And I looked at him and I said, dude, think about what you just said.
What planet are you on? Yeah,
if you can keep 15% a year every year, you would be fine. Yeah, most people would. Yeah. The problem is that's not reality, and it's not realistic either, right? So you're banking on the fact that nothing ever goes wrong.
Well, and that's just not how it works.
It's not how it works.
We talk about this with clients all the time, that there's the concept of reversion to the mean, so to speak. And the easiest way I found to explain it, I mean, if you stretch a rubber band out, you pull that rubber band up. I mean, at some point when you let it go, it's going to drop below that mean, that middle point, and then come back up again. And markets do the same. The average is the average. You look at the last, how many every year average, you're talking depending on the indice, 9-10%, somewhere in that range. So I always tell clients, hey, anytime you earn more than that in a year, remember, you're just borrowing from future years is all you're doing. At some point, you're going to give those back. So as enticing as it would be to have a huge year again, I mean, just think of that rubber band, right? The further up you pull it, I mean, it starts to, you let go of that, it's going to drop even further.
Yeah.
So,
well, and think about how spoiled we got, Phil, from basically 2010 to 2020, if you really just kind of want to keep it simple, until the COVID downturn. And even that was short-lived, right? But I mean, it's like you cannot expect a 15, a 10, a 12, a 14, a 15-year constant up. And even in there, in 2018, we saw a little bit of a dip,
right.
It's going to do its thing.
Good decade or more. So
yeah, right. Which is much better than the lost decade of 2000. So absolutely. Right. But again, I think we have to be realistic. So yeah, to your point, an 8 to 10%, kind of analysis of 2025 potential is not bad at all.
That to me would be good. I mean, that means the market's cooling and getting a chance to catch up. Right. I mean, because earnings have to support these prices, which, I mean, there's been good earnings in 24, a lot of it again driven by AI. But that, I think that's a big wave that came in, huge demand as it started out, a lot of excitement around AI. And I think that's going to continue.
Yeah.
But like anything, I mean, that first year of anything is always like everyone's on the bandwagon. Oh, this is the greatest thing. And it just, takes off. Yeah. At some point, it's got to get into that normality and get built into everyone's business.
Yeah. What's the groove, right? What's the groove? I mean, think about crypto, same way, right? It was like, and then it's down and then it's, so.
Yeah, crypto is going to be the same thing. I mean,
it's going to stay the same.
Really starting to come to the forefront and
the mainstream as well.
Life in the mainstream. Yep.
Yeah.
So we'll see what that does in the new year. So
well, and so consumer spending is the other economic outlook. You touched on that a little bit already. Obviously, if inflation stays low, people are feeling better. I mean, that's one of the things obviously Trump was running on. Is trying to get the bills back down, which is going to tie into the energy sector, right? I mean, all of this I talked about as well. In order to get some of these prices under control. Because let's be honest, once companies can raise the prices, they don't want to take them back down, right? So it's not like they're going to go, hey, let's put our prices back to what they were in 2018 or 2019. Yeah, they're not going to do that.
It doesn't happen.
But if we can get the energy sector rolling and we can get transportation costs down and so on and so forth, we should start to see some relief. But that does, as we talked about, 2 months ago, take a little time. So the first quarter is going to be a little choppy.
It's going to be a little choppy, especially as the new administration comes in. They start to make their
fast and furious.
Yep. Yeah, they're fast and furious. Their first swath through all the changes and things they're going to do. Mm-hmm. We'll see what happens. Tariffs
that's going to be a big piece.
I mean, that's going to be a big piece. We kind of see what that plays out to be.
Yeah.
I think a lot of it has been setting himself up for negotiations. I mean, what tariffs happen?
I think there's been a lot of that. Yeah.
Yeah. I mean,
it's pre-staging. Yeah.
Yeah. Trump's a businessman. I mean, he likes to talk big, kind of setting the stage, and then you go in and negotiate. I mean, that's what you do in business. That's how it works. He's done real estate
and
for
look
years.
at
This is what he does. And
yeah, and look at
he's already getting the countries come to him and say, hey, we need to talk.
And I was going to say, with Trudeau announcing he'll resign this week. At the time we're taping this, I don't think he's done it yet, but by the time we drop it on Thursday, he may have. So that's going to change that landscape with the conversations that we have on things that we trade back and forth with Canada, right? A lot of stuff that we move back and forth with Canada. So, I just saw the other day that Mexico reversed their stance, first saying they weren't going to take some of the immigration issues. Now they say they will accept it. So there's, to your point, there's a lot of back and forth
staging and
and that's going to affect
expectations, so that then we can negotiate something a little lower than that. But I mean, obviously it's still going to have potentially some effect on the economy.
It'll have some economic effect. It's not just the political landscape. It will have economic effect as well.
Right.
To
me, the biggest wild card in all of it is the geopolitical risk still. I mean, it's,
and the tariffs. I mean, to your point, the tariffs are going to be a big piece of this.
Yep. So those are the two kind of wild cards, and we'll kind of see what plays out.
The Tax Smart Retiree is your comprehensive guide to mastering tax efficiency for a flourishing retirement. You will find indispensable advice and actionable strategies designed to enhance tax savings, maximize Social Security benefits, protect against market volatility, and develop a customized retirement plan. To get your free ebook, click the link in the show notes of today's episode and download your copy of the Tax Smart Retiree right now.
All right, so what's some key themes to watch in 2025 we may want to keep our eye on as we revisit this topic throughout the year?
Well, it's going to be interest rates. I mean, keep an eye on the Fed, see what happens there, which that ties in heavily with inflation and where things are going there. Look for growth, see what happens with the GDP. Are we kind of leveling off, or are we going to start to see that grow heavily? Inflation's coming back, and let's see what happens with the big companies, the AI companies, the kind of those mega companies. That's what's driven the market so far. Are they going to cool off in 2025, or are they going to continue to kind of lead the charge?
Yeah. Our GDP for 2024 looks to be right around 29 trillion. I know they don't have the final data yet since it's only the 7th, but at the time we're taping this, but so 29 trillion, obviously we got more debt than that. We got more debt than we're GDP. And obviously this is part of the reason why we're in the pickle that we're in. So hopefully that number, to your point, does tick up.
Yeah. So, I mean, I would look at kind of a theme for 2025 is cautious optimism is what I put on it. So,
okay.
I mean, I'm optimistic that I think, things should continue. Probably at a slower pace, hopefully at a slower pace, but cautious. I mean, there's a lot of,
at least,
So.
There's some headwinds that, we'll experience some turbulence there when he starts making executive orders and some policies start to get put in place, and as things kind of get smoothed out. I think the idea is that probably a little bit of a rough first half of the year and then a better second half of the year, which would make a lot of sense. I mean, anytime you have administration changes, that tends to be the case, with a little bit of with some strokes of the pen. So yeah, I mean, cautiously optimistic is a good term. I like that.
Markets always like consistency. They like to know what's coming. I mean, that's what
that's not what we're going to get this go around.
Like any of us, right? I mean, it's what we like. But when you don't get that, when there's uncertainty or when things don't go the way you anticipate it, that's when you start to see the volatility. So
yeah, exactly.
I think expect that in the first quarter as things kind of get settled in and changes happen.
Well, and unfortunately, we know that our leaders, no matter what side you find yourself on, they don't seem to want to play with each other very well. So, that will add to the tension. Hopefully, they will listen to the majority of Americans and just say, "Look, we just want to fix some things here. Can you guys please do your job and work together?"
Right.
We'll see. Right. That's always the the catch-22 when dealing with the politicians. But we'll walk with it and see what we get, and we'll work our way through it. So cautiously optimistic, and I think that's important too, especially if you find yourself yet another year closer to retirement, or planning or strategizing. Get with your advisor if you haven't done so yet, or if you have been kind of dropping the ball or kind of, dragging your feet a little bit, waiting to see what happens. That's always, that kind of mindset. I'll wait till things calm down before I take some action. That's usually not, when is life ever going to calm down?
Yes, right? It'll never happen.
So
putting it off. So
Yeah. So we got links in the show description. Reach out to Phil, get yourself some time on the calendar, have a conversation with him. If not with him, have a conversation with a qualified professional. Of course, Phil is a CPA and a personal financial specialist, so he's got many years of experience helping people with their retirement and strategy situations. So if you got some questions, need some help, reach out to Phil. He'll certainly have a chat with you. And don't forget to subscribe to us on Apple, Spotify, and of course, YouTube. We certainly appreciate all the growth we saw in the last few months on the YouTube channel. So keep it coming. We appreciate it. And drop us a comment in the links below if you got some things or some thoughts you want us to talk about or dive into. We'd be happy to tackle that as well. Phil, my friend, thanks for hanging out, brother. I appreciate it.
Have a good day.
You have a good day as well. We'll see you next time here on Phil's Tax Hacks and Other Retirement Facts.
Investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and/or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives.